Good afternoon, everybody. Welcome to the Spending Affordability Committee's first hearing of our fall session. I am Delegate Mark Corman, the new chair of the committee. Shout out to now Senator Mike Jackson, my predecessor, who chaired this body last year. Before I turn it over to DLS and my Senate colleague, I want to see if Speaker Jones or Chair McIntosh or Chair Kaiser, if she's on, have any opening comments. Okay, let me kick it over to Chair Rosapep.
Well, first, let me ask if Chair Gazzoni has any comments.
Good, thanks.
Thank you. Well, I just want to say that I'm also new Senate chair of this committee, and we're doing this at a very important time, as I think we all know. As a result of the fast recovery in the economy and the fiscal stimulus, the Trump administration, Biden administration, Congress, Hogan administration, and our own legislature provided over the past 18 months, the fiscal situation in the state is in dramatically better position than it's been as long as I've been in the Senate, which is 15 years. And there may be some members who remember as good a fiscal situation we have today. And therefore, the work of the Spending Affordability Committee this year is as important as ever, but very different than in the past when we were facing projected structural deficits and potential shortfalls in the current year. And obviously, as we will talk about more today, the projections right now are for substantial surplus for this coming year and projected positive balances going forward. That's going to require big decisions in the short run and big decisions as the spending affordability is designed to provide for the long-term fiscal stability of the state. So I look forward to working with everybody over the next, it's really like 2 months because we do this before the end of the year, to come to an agreement on a plan that's fiscally responsible that we think will do the best for the state going forward. With that, Mr. Chairman, it's yours.
Well said, Chair Rosapep. Ditto. I think, as everybody knows, we're going to turn it over to the Department of Legislative Services, and they'll march through a series of their specialists to go through each issue area, and we'll start with our MC, David Romans.
Thank you to both the chairs, and good afternoon. We're going to cover a lot of ground today: the revenues, economy, the budget outlook, both in the near term and the longer term, as well as transportation, debt affordability, and a little bit on the federal infrastructure bill. The Senate chair actually kind of covered a lot of my opening remarks. You really are in a uniquely favorable position right now. I think it's really the best in a generation in terms of state finances. I mean, as you'll hear, we're looking in the current year at closing with about $3.7 billion in fund balance. And we have a structural outlook that for a few years anyway has us with a structural surplus, not a deficit, a surplus of over $1 billion a year. So you have some unique opportunities to make some investments, both in kind of one-time spending and some ongoing ones. Of course, revenues remain, uncertain. I mean, they're very favorable right now, but that can change quickly. So you should, think strategically about how you want to spend that balance and not try to overcommit. So with that, I think I guess I should say also, the other thing we're going to do is we're going to throw out there a little over $2 billion of ideas for sort of good government, wise fiscal actions to do with some of that cash balance. So we'll get into that later. I'm going to turn it over to Teresa Chizinski, who's going to talk about revenues and the economy to get us started.
Thank you. Thank you, Mr. Chairman. I guess someone's going to say, there we go. There's the document. And I'm going to start right on page 1. If we can move to page 1, there we go. This is fiscal 2021 general fund revenues, both the actual revenues compared to the estimate, as well as comparing it to fiscal 2020. As I'm sure you're aware, we exceeded the estimate by a significant amount in fiscal 2021, $1.7 billion. Revenues grew 11.8%. Much of the overattainment was in the personal income tax, which is by far the biggest revenue source in the general fund. That was over the estimate by $903 million and grew 9.4%. Payments with tax year 2020 returns exceeded the estimate by a significant amount, while refunds were below estimate. Refunds related to both unemployment insurance benefits as well as the refundable earned income credit were less than anticipated, and I'll talk about that a little bit coming up. But other components of the personal income tax were above the estimate as well, including withholding and quarterly estimated payments. The corporate income tax was also over the estimate by $323 million. It grew 39% over fiscal 20. Gross receipts were up 31%, but refunds fell 15%. But refunds in fiscal 21 were primarily for tax year 2019, with the balance for tax year 2018. So the corporate income tax is often quite backwards looking. The sales tax was up almost $400 million, grew 7.6%. The sales tax in fiscal 20 had actually fallen 3.7%. Strong fiscal support from the federal government in the form of enhanced unemployment insurance benefits, stimulus checks, et cetera, supplemented wage growth to the benefit of the sales tax. In addition, the sales tax benefited from a shift in consumer spending away from services, which are generally not taxed, to taxable goods. The other thing on this chart, page 1, is the performance of certain selected special funds that contribute to funding for education. Revenues from the casinos, which go to the Education Trust Fund, were over the estimate by $20 million, entirely due to good performance on the VLT side of the casinos. There was a provision in the 2019 Budget Reconciliation and Financing Act, which directed corporate filing fees above $63 million to education funding in fiscal 2021 only. This was over the estimate by $34 million. Fees were almost $150 million in fiscal 21, up 104% over fiscal 20. They had actually fallen 26% in fiscal 20. Some of this is due to recovery from the pandemic, but some of it is also probably due to the way revenues were split between fiscal 21 and fiscal 20, with probably too much revenue booked to 21 that should have been accrued back to fiscal 20 at the time of the fiscal 2020 closeout. And the other big category is the sales tax, which is shared with the Blueprint Fund. Sales tax from certain online sales are shared between the general fund, which gets the first 100 million, and the Blueprint. These are revenues from remote sellers who were required to collect the sales tax following the Supreme Court Wayfair decision, as well as marketplace facilitators who were required to collect the sales tax from their third-party sales, and that was the result of legislation from the 2019 session. In addition, sales tax revenue from digital goods all goes to the Blueprint. So total revenues from this bucket of sales tax revenue was $523 million in fiscal 21. The general fund got $100 million, so the Blueprint got $423 million. And you can see this was under the estimate by about $136 million. But the Comptroller's Office is aware that they have undercounted the relevant tax revenue, currently estimated at $88 million. What that means is the Blueprint should have gotten more money and the general fund should have gotten less. The Comptroller plans to make an extra distribution to the Blueprint Fund in fiscal 22 to compensate for this. It's important to note, though, that this adjustment, that $88 million, is still an estimate. Identifying this category of sales tax revenue that needs to be counted for the Blueprint is not as straightforward as you might think it would be. The Comptroller's Office has found that the self-reporting of taxpayers is not reliable, and so they have to go through a very labor-intensive manual process of going through sales tax returns to try and identify the sales tax revenue that should be counted in this category. And that can be obvious in some cases, and in other cases not. They have literally resorted to Googling company names to figure out whether they should be counted or not. And at the time of the fiscal 21 closeout, they did not have access to all the returns in order to be able to do that, which is why this number is still an estimate. And this is not necessarily a one-time only problem. We're now in November and they still have not nailed down this number. We're also several months into fiscal 2022 and we don't have any information on how revenue is coming in from this category of sales in fiscal 22. And this is not ideal for a revenue source that's become really important for education funding. One way we could get around it would be to convert the distribution to a simple percent of net receipts. And there's actually a precedent for this. When the Higher Education Investment Fund was created, it received a distribution from the corporate income tax that was related to certain tax years. And after a year or two, it became clear that was a cumbersome and burdensome way to try and do it. And so the distribution was converted to a simple 6% of net receipts. We could do something similar for the blueprint. The blueprint is estimated in fiscal 22 to get about 10% of net receipts in the sales tax, exclusive of that extra payment. Under the current BRE forecast, that rises to 11.5% in fiscal 2027. That would bring a lot of clarity to how much revenue the blueprint is going to get, not only at the end of the fiscal year, but throughout the fiscal year. We would know every single month exactly how much money is going into the blueprint, and it would really clear things up a bit. And that takes us to the revenue forecast on the next chart. As you're probably aware, the Board of Revenue Estimates put out a revenue forecast at the end of September. They revised fiscal 2022, and they put out a new estimate for fiscal 2023. They revised fiscal 22 up $995 million, and they are estimating growth of 5.5% in fiscal 2023. Now, the upward revision in fiscal 22 is considerably less than the overattainment in fiscal 2021. There's a couple reasons for that, including the issue with the blueprint fund I just talked about. But there's a bunch of issues in the personal income tax that boosted revenues in fiscal 21 in a way that was not going to carry forward into fiscal 22. And so the upward revision to the income tax is about less than half of the overattainment in fiscal 21. The first of these issues relates to pass-through entities, or PTEs. There was legislation at the 2020 session that allowed PTEs to make estimated payments for their resident members. Previously, they could only do this for non-resident members. This change is revenue neutral for the state and local income tax, but it is advantageous at the federal level. And so the Comptroller's Office saw a surge of PTE estimated payments beginning with the tax year 2020 fourth quarter payment. This had the effect of pulling forward revenue into fiscal 2021 that otherwise would have shown up on tax returns in fiscal 2022. As I mentioned earlier, there were issues with the refundable earned income credit. Refunds were lower than expected in fiscal 2021. Despite the enhancement and expansion of the credit in chapters 39 and 40 from the 2021 session, those changes were made after the tax filing season had already begun. So it's possible people who filed early missed them. But of course, going forward, that's not going to be true. These changes are now in law. As we go into the tax year 2021 filing season in January, they will be there and that will not be an issue. It's also the case that tax returns are continuing to be filed. They don't stop at the end of fiscal 2021. And we continue to keep paying out refundable earned income credits. In fact, quite a lot of money has gone out. Close to over $70 million in refundable earned income credits were paid out between the end of fiscal 21 and the end of September, which is the latest data we have. So that could be people continuing to file tax returns. It could even be some people filing amended returns to go back and take advantage of the enhancement. There's a similar issue with tax payments for unemployment insurance benefits. They were higher than expected, given that the Relief Act from the 2021 session had exempted benefits from taxation for most taxpayers, those under a certain income threshold. Some of the taxpayers who ended up paying were actually above the threshold, and so they had to pay. But a lot of people could have taken a subtraction modification for this, and they did not. And again, the fact that the law was changed partway through the tax filing season might have been an issue. And again, that's not going to be true going forward. And finally, there was a provision in the federal rescue plan that was passed in March that made changes to the tax year 2021 federal earned income credit and child tax credit in ways that flow through to the Maryland personal income tax, reducing revenues mostly in fiscal 22, a little bit in fiscal 2023. The BRE is expecting continued strong growth in the sales tax, 5.9% in fiscal 2022, 4.5% in fiscal 2023. This is a reflection of continuing recovery in the economy in the aftermath of the recession induced by the pandemic, as well as substantial consumer savings. Moody's Analytics estimates that nationwide households have saved $2.6 trillion in excess savings. That is savings above what households would have saved absent the pandemic. And that takes us to the economy. And the next couple of charts deal with some economic statistics and economic forecasts. Starting on page 3 with the employment forecast. This is the year-over-year percent change in Maryland employment for calendar years 2020 through 2022. In calendar 20, employment fell 6.8%. That's about 188,000 jobs. In April of 2020, at the beginning of the pandemic, employment was down 14% or 401,000 jobs from the pre-pandemic peak in January. In calendar 21, we have data through the month of September. The yellow bar indicates that that's growth of 2.6%. As of September, the state was still down 110,000 jobs from that January 2020 pre-pandemic peak. That's about 4%. The BRE did make some changes to their employment forecast. They lowered calendar 21 a little bit to 2.9%, and they increased calendar 22 a little bit. If we turn now to the next chart and wage income, similar kind of data, year-over-year percent change, same calendar years. The actual in calendar 2020 was 1.7% growth. This is a little bit above what you see in that dark blue bar as the BRE September number, which is 1.1%. The reason is that after the BRE finalized their revenue forecast last month, the US Department of Commerce put out state personal income data and they revised the history. So the history is now 1.7% growth. That's pretty weak growth in historical terms, but quite significant, especially when you consider that employment had fallen so much. And that fed directly into the income tax. It was an important factor behind the overattainment because tax withholding from wages is by far the biggest component of the personal income tax. In 2021, we have data through the first half of the year, and that's up 9.3%. Obviously, this is exaggerated by comparisons to the initial months of the pandemic. In the second quarter of last year, wages actually fell 2.4%, so it's exaggerated. But the BRE is expecting growth to be about 7% in 2021, and they also revised up their estimate of wage growth in 2022. And again, this feeds directly into withholding, directly into the income tax forecast. So it is important, it is a significant change for the income tax forecast. Another important factor for the, and I should say too, it also is important for other things as well, like the sales tax and such. Another important factor for the income tax is capital gains income, and that's the next chart on page 5. Here we're showing you the year-over-year percent change for 4 years because calendar 19 remains an estimate. We rely on the IRS for this data, and they still have not released calendar 2019 data. There's a big revision to calendar 20, up 21%, reflecting the sharp drop and then the strong rebound in the stock market last year. But this is the history. It's mostly catching up with what's already happened. In calendar 2021, the BRE did revise up to 10% growth. Even with the recent fluctuations in the market, the S&P 500 is still up 27% from the beginning of the year. I believe it's once again at record levels. And then there was a small change in 22. These estimates for calendar 21 and 22 piggyback on projections of US taxable capital gains income from the Congressional Budget Office that came out over the summer. And again, this is a variable that feeds directly into the personal income tax estimate. We have one more economic variable on the last chart I'll talk about. This isn't really a forecast, it's just some history, but it gets at this idea of savings and the savings rate. As I mentioned, Moody's has estimated what excess savings were across the whole US. We don't have the data to do that at the Maryland level, but this tries to get kind of close to it. Savings is very simply just income minus spending. You have income, you spend so much, whatever you don't spend, if you don't spend it all, is savings. And if we take savings and divide it by income, that is the savings rate. What percentage of your income have you saved? And this data shows that calculation for both the Maryland, which is the blue line, and the US, which is the red line, going back to calendar 2000 through calendar 2020. We're defining spending here as personal consumption expenditures. This is a very broad measure of consumer spending. It includes not only things like retail sales, but also housing costs, healthcare services, other professional services. It's not everything people spend money on, but it's a significant chunk of it. And income is defined as disposable personal income, which is simply personal income less taxes. You'll notice a couple things about the graph. One is that Maryland is above the US in every single year. This is probably a reflection of the fact that Maryland is a relatively high income state, and your ability to save is obviously highly correlated with the level of your income. The more income you have, the easier it is to save. You'll also notice that Maryland has bounced around 15% for most of this time period, falling during recessions. It fell quite a bit during the housing bubble in 2005 and 2006, as people had a lot of real estate gains and real estate wealth. They felt less need to save out of their current income. And then the biggest thing that stands out, of course, is that sharp spike in 2020. It rose up to 23% in Maryland, about 19% for the US. And actually both sides of the equation contributed to this. Income was up pretty good, 6.7% growth for Maryland. This is a reflection of wage growth that we talked about, but also that federal fiscal support, because things like UI benefits, stimulus checks, even the Paycheck Protection Program gets counted in personal income. So income was up, and then personal consumption expenditures, spending, fell substantially, 4.4% in Maryland. This is a series that doesn't fall very often. And it actually fell more in Maryland than it did nationwide. Nationwide, it fell 2.6%. So with an increase in income and a decline in spending, you have a substantial increase in savings last year. Now, this is, to be clear, not to say that every household in Maryland was in that situation. This is just aggregate data across the entire state. But it does provide some support for consumers, not only this year. Some of this savings was probably spent down this year. And people could be spending it, they could be paying down debt, they could be just saving it. But it is another factor that's sort of supporting the economy going forward. Fortunately, we don't have any data for 2021 for Maryland. This is data only available at an annual basis. But data for the US is available every month. And if we look at 2021, in the first 9 months of the year, the rate for the US, that red line, comes down to about 16%. So it was 19 in 2020, and in the first 9 months of the year, it's down to 16. But that's very different throughout the year. It was much higher earlier in the year and has come down since then. And in fact, in September itself, the US rate was about 10.2%, which means it was just right around where it's been and where it was pre-pandemic. So this is normalizing. This is not an ongoing thing. This is something that is a function of the pandemic. It spiked. It's probably a little still elevated this year, but it's coming down quickly. But it does provide some support for the economy, at least over the next year or so. And that's all I have on the revenues and the economy, Mr. Chairman. I am happy to take questions.
I think we'll probably, if it's okay with Chair Rosapep, continue through the DLS march and then do questions at the end. Does that work, Chair Rosapep?
Frankly, I'd rather take questions as we go along, just so they're more focused on the shorter term stuff, if that's okay.
With me, if folks want to use their raise hand function, not gonna be able to see you waving on your screen given the volume of people. You can recognize yourself, Mr. Chairman.
I guess I didn't want to dive ahead of other people, but I'd like to ask about how you see the current inflation and projections of inflation fitting into this storyline. Because obviously we've had very low inflation in very recent years, but now we have higher inflation evidently coming out of the dislocation from COVID. We also, the Federal Reserve Board, talking again about potentially raising interest rates. Just help us understand how these economic projections you're talking about then lead into our fiscal projections. That's obviously a risk factor. How is that taking account in this analysis?
Well, the thing about the revenue forecast is that it's all done in nominal terms. Right? We're not adjusting for inflation, in part because people not only are paid in nominal terms, they pay their taxes in nominal terms. So it's in terms of the economic forecast, the economic consultants that we rely on are certainly factoring in the impact of inflation and these supply chain disruptions that have kind of precipitated it. But they're also all assuming that inflation is, as the Fed likes to say, to a certain degree, transitory. So inflation is elevated here in 2021. It remains a little bit elevated in 2022, but quickly comes down to more around that 2% rate by 2023. So they are assuming it's going to get worked out. In terms of the Fed raising interest rates, although the Fed is starting to taper their bond buying program this month, I think most economists still think they're not going to look at actually raising rates until at the earliest late next year. And I think Chairman Powell at his most recent press conference was pretty clear that just because they were tapering bond buying doesn't mean that they're ready to raise interest rates. But I think generally speaking, the assumption is that the Fed's going to be able to manage the situation and get down to an inflation rate that's closer to 2% as we work through these supply chain problems. Now, I think every economist would acknowledge that this has gone on longer than they originally thought earlier in the year. And now on top of what had been problems with used cars and lumber and semiconductors and stuff, we've now seen a pretty significant increase in energy prices over the last month or so. So it is a risk to the forecast, and if to the extent that it has, some negative effects on the economy. It's possible that some of this built up savings, for example, is quickly disappearing as people, and partly being eaten up by inflation. So it may not be the support that I just argued it would be in the next year or two, because maybe a lot of it's already quickly disappearing. So that's kind of the way that, the consultants that we use are sort of seeing it. Basically, we're going to get back to not the low inflation of the pre-pandemic era, but something around 2% in fairly short order.
Thank you, Delegate Henson.
Thank you, Mr. Chair. Thank you, Ms. Chudzinski, for your presentation. I'm particularly interested on the slide on page 3 that talks about getting back to work and about our unemployment and the recovery from the job losses. Do we have any information that breaks it down on demographics on what the recovery and reentering the job market looks like?
We don't really have, I can look into it. I don't know that there's a lot of data on the state level breaking down like unemployment rates by demographics. There's some national data for that, but I don't know that there's current data for that at the state level, but I can look into that and see what I can find.
Thank you. Thank you, Mr. Chair.
Delegate Novotny.
Thank you, Mr. Chair. Thank you for the presentation. I remember last year when we were receiving funds from the federal government, there were a couple of provisions. One was included the fact that we were unable to give either money directly to taxpayers or reduce taxes in that stimulus. It stipulated that. So I guess my question is, while we're talking through this, do those rules still apply? And then kind of the secondary question is, I don't remember ever hearing whether or not when we passed a law giving undocumented immigrants and those without social security numbers, if that was ever ruled on directly by the federal government because of that conflict.
Well,
Mr. Chairman, it's David Romans. I'm going to answer that question. To the second part of the question, it really covers both parts. There's a DeMinimis provision in the federal rules on that tax, on cutting taxes and changing your taxes. And the changes we made, including that provision for the I-10 filers, falls within the DeMinimis provision. So we are not being penalized by the federal government because the total dollar amounts of the actions we took last session were relatively small. The provision does stay in effect as long as we're getting the federal money, which is a few more years. So we would have to take that into account if there's a significant tax reduction in future years.
Thank you, Mr. Chair.
Great. Teresa, one more question for me. I don't see any other hands up, but when you were talking about the difficulty of projecting the sales tax of the Blueprint Fund, is that from the online facilitators as well as the digital downloads, or was it one more than the other?
It's all of it, really. Probably less so the facilitators, which tend to be big companies, although they have found companies you would never expect calling themselves marketplace facilitators. I mean, they had some grocery stores, indicating on their sales tax return that they were marketplace facilitators. And part of it's probably just confusion on the part of the taxpayers. But they're now dealing with the digital goods because that provision just went into effect. It was legislation for the 2020 session that had been vetoed, and the override only happened in the 21 session. But they're finding the same thing. Again, they just cannot rely on the self-reporting of the taxpayer. And then the more the extent that there are smaller companies involved in this that they haven't necessarily heard of, then it's tricky for them. They have to really go through return by return and try and identify who those companies might be. And it's also complicated because not a lot of companies have more than one sales tax account. And so they file under multiple accounts and you have to make sure you get all of them. So it really is across the board on all three categories.
Thank you. I don't see any other questions on the economic outlook, so we'll turn back to David Romans on the general fund outlook.
Yeah, let's turn to the next slide. We'll turn to looking at sort of putting the spending and the revenues together here. So this chart just looks at fiscal 21 through fiscal 22, 23, and 22 and 23 reflect the DLS kind of revised estimates of what the spending will be in 22 and 23, and then it compares it to the revenues that Teresa talked about, as well as the fund balance. Now, the first place I'd ask you to look is in that box in the middle of the page. The top line in the box is the cash balance at the end of each fiscal year. And you can see we closed fiscal 21 with $3.2 billion in the general fund as surplus. And we expect that to grow to a little over almost 3.6 billion in fiscal 22. Now you may wonder, why does it go down so much in 23 to the 1.7 billion? That's really just an artifact of state law requires that most of the surplus from 21 be swept into the rainy day fund in the fiscal 23 budget. So the governor will be appropriating about 2.5 billion of that surplus to the rainy day fund. So our estimates just leave the money in the rainy day fund. It's worth noting the governor has the authority to transfer money out in the budget bill, as long as he keeps the rainy day fund above 5%. So if the governor has a plan to spend the money, I would think he'll bring a significant chunk of money out of the rainy day fund as part of the 23 budget. We're showing it just sitting in the rainy day fund, which is why that cash balance drops. The other, I think, important line in this chart is the very last line. The available cash balance above 5% of general fund revenues. We use that as a threshold because the state has long tried to have at least 5% in the rainy day fund. And you can see in 22, we're expecting to have $3.7 billion above that 5% threshold, and then growing to about 4.2 billion in 23. And that's where, early on, I was talking about how you have a lot of cash to think about making some one-time investments. And that's this pot that you really have to work with along with the governor. So it's a lot of opportunity there. I would remind you, unfortunately for the General Assembly, the governor gets the first cut at this. So his budget will sort of decide how to allocate that cash. All right, let's go to the next slide, please. This just tries to put the amount of cash we have in some historical perspective. It shows the total rainy day fund balance in the green, plus in the red, and then the general fund balance in the green. And all combined in 23, we're estimating nearly $5.3 billion. And you can see that as a percentage of the general fund is nearly 25%. We have really not approached that even back in 2006, which was a very good year for the state budget, and we didn't get anywhere close to 25%. So it gives you a sense of just how unique the situation is and the kind of unique opportunity that you have thinking about how to use that money. Let's go to the next slide. All right, so now we're going to turn to looking at sort of the longer term budget outlook. And this chart looks at the structural budget outlook. So that's the ongoing revenues versus ongoing spending. And the blue bars show you what the forecast was at the end of the session after taking into account all the legislation that had been passed. And the yellow bars are the updated forecasts using our baseline estimates. And things are obviously much better, and that's largely because of the revenues are so much better. And you can see fiscal 24 through 26, well over $1 billion structural surpluses are being forecast. I don't recall ever having DLS present this sort of surplus on the structural side to the committee over a multi-year period. I would note two things about that surplus. One is part of the growth from 23 to 24 is because you provided some temporary tax relief last year for the refundable earned income tax credit recipients. You essentially provided a better benefit, and you also extended it to people who don't have Social Security numbers. So those two things go away after fiscal 23, and that is worth them about 230 million of revenue. So that's part of why things get so much better in 24 is the sunsetting of that temporary tax relief. The other thing to note here is if you look out at fiscal 27 and 28, you see that structural surplus starts to shrink. And the reason for that is that the Blueprint Fund is able to support all of the Kerwin implementation costs through fiscal 26. But starting in fiscal 27, some supplement from the general fund is going to be necessary, then a larger supplement in 28. And that's what causes the structural surplus to start shrinking. And if we go to the next page, we'll talk a little bit about the Blueprint Fund. So the green bars here show you the fund balance in the Blueprint Fund at the end of each fiscal year. under the set of assumptions we use in our baseline. And maybe the most important assumption is we assumed in our baseline that we would get no revenue throughout this period from the digital advertising tax that was enacted last session. So under that scenario, we're good through fiscal 26. We still have a $304 million balance in the Blueprint Fund. But in fiscal 27, the Blueprint Fund doesn't have enough money to cover all of the Kerwin implementation costs, and about $460 million of general funds would be needed to supplement. And then that number would grow to about $1 billion in fiscal 28 and would likely grow by about $300 million a year for the next couple of years after that. The alternative scenario we show here is the blue line, which makes an assumption that at some point you're going to see some digital advertising revenues. The holdup there is really that this is going to be litigated, and it could take quite a long time to get through the legal process. But if the state were successful and we were to assume that we started getting revenues in fiscal 26, the estimate is we would get roughly $250 million a year. So we get $250 million in 26 and then each subsequent year. That would mean the Blueprint Fund could fund all of the Kerwin costs through fiscal 27, actually closing 27 with about a $40 million balance. But in 28, we would still need a nearly $800 million surplus. So, I mean, under either case, you're in good shape in the near term, but there will be some need for general funds at some point in the longer term, unless that digital advertising revenue starts coming in much, much sooner than is assumed here. Now let's go to the next slide. And so this slide just looks at general fund and rainy day fund balances at the end of each fiscal year. So where is your cash situation? And you see it shows it growing and growing and growing. And that's because you have a huge balance now and it keeps growing because you have structural surpluses each year. This will never come to fruition because between the governor and yourselves, you'll identify tax relief and spending provisions to make use of some of that one-time money and probably closing some of that structural surplus as well. But if you just let it play out without making any additional spending commitments, the balance would grow to an extraordinary level by fiscal 28. So that is sort of the budget big picture. I'm going to turn it over in a minute to Tanya Zimmerman, who's going to talk about the details of our forecast. But if there's any questions on the big picture, happy to answer those now.
Mr. Chairman, do we have any?
I don't see any, Mr. Chairman.
Then I will ask one. Again, how does inflation fit into these projections on state costs? I mean, I get it that the taxes are in nominal terms, but state costs are also they're in nominal terms as well. And so, how does that affect these balances?
Right. So, I mean, Tanya will talk a little more about it in a moment. But I mean, one of the things we did in our forecasts is in recent years, we've forecasted very little in the way of salary growth for state employees. We usually assume like a 1% salary increase. In this year's forecast for 23 and for all of the subsequent years, we built in both general salary increase or COLA, if you will, and merit increases. And we really haven't seen that combination of things in recent years. So we're assuming, roughly 3% salary growth each year, which really hasn't been assumed before. Now that may not be enough to keep up with kind of the wage pressures out there, but we did build that in, which is a big driver of costs in the state budget. And we do assume some inflation for, just purchasing other goods and so forth, but we did not assume really significant inflation in the out years for really any of the services. But in the near term, we did try to build in some reflection that we are in a high inflation period right now.
Thank you.
Thank you. Let me recognize Chair McIntosh.
Very much, Mr. Chairman. Dave, I want to just stick with your last chart here, which shows that basically if we do nothing, if we are cautious about our budgeting this year, we will end up with these very large surpluses you mentioned. The previous slide, you talked about the fact that in planning for the future for the blueprint, we have to anticipate in FY 27 and 28, we will need to add more money into that blueprint cost. So, I mean, one way of looking at this is that And 27 and 28, we could make decisions right now that would, in fact, have that infill of money in FY 27 and 28, waiting and available for us when that time comes. Is that correct, that I'm looking at that in that correctly?
Yes, that is correct. You certainly have a large fund balance. You could allocate some of that money to the Blueprint Fund. You also, just to pick up on what Teresa said earlier, where there's a lot of difficulty in the controller's office correctly assigning revenues to the Blueprint Fund versus the general fund. And she floated the idea of maybe you should just set a percentage of all the sales tax revenue goes to the Blueprint Fund. If you were going to do something like that, you could boost that percentage up a little bit to send a little bit of extra money to the Blueprint Fund each year, which will also have the effect of increasing the balance in the Blueprint Fund and helping you get through 27 and 28.
All right, because it's really FY 28 that will be the hardest reach. And then after that, it levels off at a fairly, not insignificant, but a very doable level. Am I correct?
Absolutely correct.
Okay, thank you.
Delegate Resnick.
Thank you, Mr. Chair. Dave, thanks. Something that Senator Rosenberg, I believe, asked earlier when it comes to taking into account the cost of state costs and growth. You had mentioned salary increases are built in nominally at 1% a year. There's an additional potential cost hanging out there. I know that state employees have filed a legal action concerning emergency pay during COVID. And I know that it's working its way through various legal channels right now and could potentially have a significant impact on the budget. Could you talk a little bit about what that amount looks like and how that would affect the budget?
I haven't seen a dollar value. There may be one out there, but I have not seen what the dollar value of that would be. Obviously, with the large surplus that we have, if there is some sort of significant payment that needs to be made retroactively, we certainly have the cash to do so.
All right, thank you.
Chair Rosenberg, I don't see any other questions. I think we can turn it over to Tanya Zimmerman, who we can also congratulate on her new position.
Congratulations.
Thank you. So the first slides I have for you here are related to what some of the key assumptions were when we were putting together the baseline. The first key assumption relates to the length of time that we'll have the enhanced Medicaid match. Consistent with the recent extension of the public health emergency, we're assuming that the enhanced Medicaid match continues through the end of the first quarter of calendar 2022. And going along with that, then the requirements related to the continuous enrollment in Medicaid will continue through that first quarter as well. So that recertifications would begin in April 2022 with kind of a phase-in lasting 12 months. We're also assuming that there will continue to be work in progress on the reconciliation and the Behavioral Health Administration for the estimated payments. And so we're assuming a recovery over 2 years of $110 million. We're also, for other public assistance cases, we're assuming that recertifications begin in January 2022 after the end of current waivers that go through the end of the calendar year. And that leads to some of those kind of caseload drops that you see in the chart below. The K-12 enrollment is projected to increase by about 3.8%. And that's because we used estimates that were developed pre-pandemic to forecast those levels. The actual enrollment won't be known until December 1. Go to the next page. There's also an assumption that consistent with the plans that there will be a fund swap of American Rescue Plan Act funds for general funds. There was a plan to do that to refund the economic recovery initiative from the fall of 2020 with those funds. Those weren't allowed, that wasn't allowed to occur based on guidance. And so that the assumption is that will happen this year instead. There are additional assumptions related to personnel. As was just mentioned, we've assumed some increases for general salary increases and merit increases. There was also some provisions related to a bonus and an additional general salary increase in fiscal 2022 for certain bargaining units. That would also apply to exempt and non-represented employees that were conditional on revenues coming in over BRE estimates by a certain amount, and those conditions were met. So we're assuming that those occur. We also assume filling of about 1,700 of a current number of 5,600 vacancies in the executive branch. We'll talk a little bit more about that in a moment. You can also see the last bullet includes some of the assumptions that we made for fiscal 2023 related to inflation in certain key areas of the budget. And that includes some inflation for like food costs of 10% that are based on some of the kind of the recent trends. You go to the next slide. So back to the vacancies, this is the October vacancies compared to the budgeted turnover rate. As you can see, the budgeted turnover rate across the state is 7.8%, and that's generally consistent kind of with what has been budgeted. The vacancies are actually over 11%, over 11.5%, and that is widespread across the various departments. 5 of the 6 largest departments have vacancy rates over 12%, and that those high vacancy rates just kind of occur throughout the department. This used to be kind of isolated among a few particular agencies, and it's just generally more widespread at this point. You go to the next slide. But this isn't a kind of one-time problem. So this looks at vacancies in October of each year in recent years. As you can see, the lines show the vacancy rate, and you can see the vacancy rate has been over 10% since 2016. The bars represent the number of authorized positions, with the green portion of that being the filled positions, and then the yellow portion being the positions that are vacant. So you can see the number of authorized positions has gone down while the vacancy rates have gone up. So in October 2021, there were more than 1,100 fewer filled positions than there were at the same time last year. And that's due to a combination of both fewer authorized positions and a higher number of vacant positions. You go to the next slide. So this shows the anticipated general fund deficiencies and the fund swap that I mentioned earlier. Overall, these reduce general fund spending by about $128 million. The largest area of increase is in entitlements. This is primarily in the area of behavioral health. This includes some fiscal 2021 bills that are being paid in fiscal 2022, as well as increased forecasted need for that program. And the next largest area of increase is in statewide personnel, and that includes the deficiencies for the COLA, the conditional COLA and bonus, as well as a health insurance deficiency, which is over $60 million of that 84.2 million. Those are partially offset by the decrease of 145 million. That's primarily due to the extra quarter of the enhanced Medicaid match compared to what was kind of assumed in the budget when it was passed. And then the remainder of the decrease that gets to kind of that total level is that general fund swap. The next slide. So this shows for the fiscal 2023 budget, the kind of major components of the growth. Overall, the budget's expected to, our baseline budget grows by over $3.3 billion. The largest component of that is the appropriation to the rainy day fund, which was discussed earlier. The largest area of decrease is in PAYGO, and that's primarily due to over $400 million of one-time funds that were provided in the budget last year. Outside of the rainy day fund, the largest area of growth is in education and library aid, and that's primarily due to inflation and the enrollment assumption that was discussed earlier. And then the next largest component is Medicaid and behavioral health, and that's really a factor of the backfilling of the enhanced Medicaid match, as well as the special funds that were placed into Medicaid through the BRFA last year from the reinsurance program. If you go to the next slide, this breaks down the kind of state agency operations increase, which is about $440 million. The largest components of that are related to compensation, which are the COLA and merit assumptions discussed earlier, and some additional health insurance and pension. The next largest area of change is kind of the public four-year higher education institutions, which increased by $90 million. About 36 million of that is related to various mandates, including the mandates related to the HBCUs. The next largest component are legislation that's kind of not accounted for elsewhere, which total about a little over $86 million. And that includes some of the other costs related to attorney fees and other costs associated with the HBCU legislation, as well as the residential tenants access to counsel and the police accountability legislation, which also includes the largest component of that increase are related to kind of the loan assistance and scholarship programs. And that is all I have for you.
Are there any questions? While people are thinking about it, I'll pull the Chair Rosa Pepperell and ask my own question, which is, do we know if other states' governments are seeing similar vacancy rate issues?
I am not aware of that. We can definitely look into that though.
I mean, obviously there's a sort of a worker crunch in a lot of different fields in a lot of different places. I'm curious if this is one that we're experiencing broadly, or if it's Maryland, as you said, we had this in a lot of isolated areas previously in Maryland. Now it's sort of spreading. So I'd just sort of be curious if there's a relatively easy way to check that.
Yeah, we can look into that.
Thank you. Let me recognize another former chair of SAC, Delegate Valentino Smith.
Thank you, Mr. Chair. Tanya, on page 12, when you talked about one of the baseline assumptions, you talked about recovering $110 million in total funds based on the Behavioral Health Administration. So I just want to clarify, that is an assumption that we will get $110 million back from behavioral mental health care providers. And does that include the Secretary's recent announcement of nominal forgiveness program for some of them?
Yes, so this is just kind of the total pot, but it does kind of take into account the amount that was forgiven. So this is only a portion of that. So this is not all of the estimated payments kind of that are still outstanding. This is just kind of a portion of it, and that it would occur over 2 years as they continue through the reconciliation process.
So this is based on information that the provider or that the contractor gave the department that they think, because we just had a hearing where the providers told us there's an inability to do a reconciliation because the department and the contractor have been unable to provide the providers with specific information with respect to how much they've been paid, when they were paid, when the claims were processed, and there's a lot of manual reconciliation going on. So I am concerned about the $110 million figure, and how the contractor and state know that, but the providers have been given no specifics with respect to what they owe back.
So this is just an estimate that we have come up with. It is not necessarily based specifically on information from the providers or the department. So this is just our estimate of what might potentially be recovered.
Okay, thank you. And then just a follow-up question, if you don't mind, Mr. Chair. I've lost track. Where are we with the lawsuit that the state employees had regarding their prescription drug coverage? And what liability we may or may not have, depending on how that was resolved?
I think Dave might have some information on that.
I'm happy to answer that. So, I mean, the issue is whether we're going to be able to make the changes to our retiree drug plan that were contemplated in the legislation, and that's all on hold while it goes through the court system. Our forecast assumes that it doesn't happen in fiscal 23. I think either in fiscal 24 or 25, we have it going into effect, but it just depends on when the court system resolves that. But through fiscal 23, we assume that the current retiree drug program stays in effect as it is while the courts work through the local living issue.
Thank you. Thank you, Mr. Romans. Thank you, Mr. Chair.
Kick it back to the Senate. Chair Rosapet. Chair Rosapet, did you have a question?
It's on mute.
I'm mute. I want to let the House members first. Let them, they have their hands up. Let them go. I'll close.
Okay, Chair McIntosh.
Yeah, thank you very much, Mr. Chairman. I won't take any more time. I want to follow up on Delegate Valentino Smith's questions. Not at this time, but I would like Dave and Tanya to better understand the reversion of $110 million from behavioral health system, because it seems very troubling to me to have that kind of reversion happening. So I just need to better understand that. And secondly, David, we just talked about the prescription drug program. I want to make sure, though, if we don't see any changes or to that program until FY, let's say 24, 25, currently are our retirees right now having a negative impact for their health insurance because of our inaction?
I would say they are not, because we basically are still in the plan that existed before the proposed
Right.
change was enacted. So it's the same plan they've been in for
Right.
many years.
So when I get, as I do, emails and people on my website, like going after me because they've lost this and they've lost that in their health insurance, we haven't done anything yet. Am I correct? They still have
Correct.
their same plan that they had 2 years ago, 3 years ago, 4 years ago. Correct?
Right.
Okay.
Correct.
I just want to make sure. That's what I thought. Thank you.
I also want to add just to a couple of questions on this issue, that we also need to watch what happens in Congress, because the bill that remains stuck in the House of Representatives actually has a provision that would significantly reduce out-of-pocket Medicare drug costs and might, kind of mitigate a lot of the impact of what the state was planning to do. So if that bill were to actually pass, that could kind of force a re-examination of what the state was doing, because it might not be have as big an impact on retirees as was expected.
Great. Thank you, Delegate Proctor.
Yes, thank you, Mr. Chair. I was looking at the reference to the adult prison population on page 12, and I guess mine is more of a request that we could use some of these resource funds for our prison population. We heard many stories last year about facilities that need to be improved, services that weren't being offered. And, we too could have a surprise Marshall evaluation. So to me, this is an opportunity to make sure the facilities and services in our prisons are appropriate and available.
Thank you, Delegate Proctor. Delegate Sullivan.
Thank you, Mr. Chair. I just had two quick questions. One, Tanya, I know you talked about the baseline and David just mentioned the reconciliation bill, which obviously may or may not go through. Do you have an updated baseline with the infrastructure bill? I mean, I know that's more sort of on the transportation side, but there are a fair number of just formula funds that we're going to see an increase. And then the other question related to Delegate Corman's question, do you have a sense of where the vacancies are within each agency? If there's more sort of prevalence in one area that we see consistency across the board, would be interesting to know as opposed to just overall vacancy rates.
We're going to have some information later about some of the areas that we're kind of expecting to see funding from the infrastructure bill. It wasn't taken into account in the baseline due to the timing of the passage and the uncertainty that kind of was going on as we were kind of completing the baseline. In terms of the vacancies, we do, depending on the agency, have some information on kind of the areas with the vacancies. So we can provide some additional detail on kind of where some of the vacancies are and some of the, particularly like in some of the larger agencies that you might be interested in.
Thank you. Yeah, I think that would be really helpful. Thank you, Mr. Chair.
Senator Rosepep, I don't see any other questions.
Thank you. Doubling down on the workforce issues, the fact that the vacancies rates are going up and the vacancy rates were pretty high already, and the fact that we have a general workforce crisis in terms of the labor market being very screwed up right now, and lots of people having shortages for hiring people. Do you know, has the administration done or has DLS done any analysis of the workforce issues broadly for the state agencies?
I think we're still looking into kind of some of what is leading to the issues. I mean, I think the vacancy rate obviously has been a kind of an issue for some time. And there have been at times hiring freezes, which also do kind of play a role into that. But I think we're still looking into what is driving some of the current trends.
Well, a suggestion, planning for reviewing the governor's budget. I think given our fiscal situation, this is a very opportune time to look at strategic changes we need to make in our workforce strategy for the state to be sure our state agencies are competitive in terms of being able to hire the folks they need. Second issue, did your analysis look at all? We know that agencies, in addition to having vacancies and pay issues and all kinds of problems, they also have been understaffed in many cases. Coming out of the Great Recession 10 years ago, we shrank state agencies. Two that come to mind that we've all learned a great deal about in the last year and a half are the health department and the labor department. Do your analysis in any way assume that we're going to make any corrections to those understaffings, or is that an issue to look at beyond the base budget that you're describing?
The base budget generally only makes assumptions about changes in positions when it's related to legislation that was passed, either in the current year or past years that had implications for the current year. So there are some assumed increases, but those are generally just related to legislation.
Okay, thank you. Thank you, Mr. Chairman.
If I can, I just want to piggyback on that last question of Senator Rosepel's. I mean, the one thing that to keep in mind is that the used to be during the last recession that the agencies really didn't have any money to hire people. There was a hiring freeze. Mm-hmm. There was very little money given to them to fill positions. So they were constrained in part by just not having the resources. Now, in the current year's budget, the administration actually provided some relief to agencies and gave them money to go ahead and start filling positions. And as I understand it, the hiring freeze has largely been lifted and is not an impediment to hiring. So I think what we're seeing is that, and our baseline assumes we continue that trend of leaving enough money for agencies to be able to fill quite a few of the vacant positions. So I think the question is becoming kind of what you referenced early on, which is, are our strategies working? Is our compensation enough? Because there is actually money for the agencies to move forward with at least filling the positions that they're authorized to fill. There's some agencies that maybe they don't even have enough authorized to really adequately staff their entity. But a lot of them, have a huge number of vacancies that they could fill if they were able to get people to take the jobs.
Right. If I just may follow up briefly, but that's really why I'm raising the question. They're two separate issues. Are they planning for enough people? And then if they're planning for enough people, are they able to hire enough people? I think what you're saying is your baseline doesn't address the issue of are they hiring enough people. It addresses how many people they're hiring, like in this fiscal year, and carrying that out. Is that a fair description?
Correct. We're assuming there's enough resources for them to make progress in filling those vacant positions, but not assuming we give them more. Because I mean, this is the challenge for the executive in recent years is until we can fill the positions we have, it's hard to justify giving more positions to some of these agencies.
I'm happy to discuss that issue later because I think they're related to each other. But thank you very, very much.
We can now turn to Rebecca Ruff to talk about cash and rainy day fund.
I'm actually going to do this first slide, and then Rebecca's going to take over after that. So what we turn to here is trying to look at, well, what would be, good government or, eat your vegetables kind of uses of the surplus. And we don't try to use it all, but we have a few suggestions for areas that you might want to allocate some of the money. The first one that Rebecca will talk quite a bit about is the rainy day fund. Now, the state has long had this policy of being at 5%, and that's pretty much all we ever leave in the rainy day fund. Is every time we get above 5%, we draw it back down. So we're proposing that you take it to 10%, and Rebecca will talk about the rationale. That would mean about $1 billion of that sort of $4 billion surplus that I talked about earlier would go to the rainy day fund. A second area to think about is we have a lot of unfunded liabilities for which we have no actual plan to repay. The biggest being retiree health with a $16 billion liability. And then the local income tax reserve is owed over $700 million, and we're self-insured for our workers' compensation for state employees. And that is also has a liability of over $300 million. So one thought is to try to tackle the two smaller liabilities by putting aside money to pay off half of the liability now. And in the case of the local income tax reserve, perhaps then mandating a small amount be provided in each subsequent year until we pay that off. Retiree health is so large, frankly, that putting $500 million aside doesn't really make much of a dent. If you really wanted to try to tackle that, it really requires a much larger annual contribution to hit the actuarially required amount and eliminate the liability. We would have to put $400 million more a year aside. The other areas that we have here, deferred maintenance, facilities renewal. Matthew Klein will talk about a little later on, but our thought is that you might want to put the money aside to eliminate the backlog for the state parks and for the Department of General Services managed facilities, and also give the four-year higher education institutions some money to help them reduce their backlog. For IT, the state has a lot of legacy systems that need to be replaced. And in some cases, are probably creating cybersecurity issues. So a thought is you could, again, set aside a chunk of money, perhaps $150 million, to help jumpstart movement on replacing some of those legacy systems. One of the notable ones is the state's financial management information system is quite old at this point, really needs to be replaced. And then capital and debt service. Now, obviously, there's a lot of things you can do in PAYGO. You all can think of many of those ideas. There's a few things that we think are really obvious that should be done. One is that right now we use the bond premium we get when we have a bond sale. Some of it's used to pay debt service, about $77 million we're assuming in fiscal 23. So what that equates to is you're borrowing money and then using it to pay the debt service, which is not a well-regarded financial practice. So given the strong fiscal position the state's in, we think you should spend general funds there instead of on premium. And then there's two areas where we know that we're sort of underfunded for capital for fiscal 23. One is between the governor's CIP last session and the commitments the General Assembly made during the session, where we are sort of overcommitted by about 125 million for fiscal 23. So we're suggesting, a PAYGO be used to cover that. And there's a lot of inflation in the construction area. That's a significant concern. We think at least 50 million more will be needed in fiscal 23 to help fund the projects that are going to bid. So all told, these things add up to about $2.5 billion of ideas for kind of trying to address known kind of needs of the state. As I said, a number of these are going to be discussed in more detail in subsequent pages by some of the other folks. So I'm going to turn it over to Rebecca to talk about the rainy day fund suggestion.
Thank you. So what you see in the chart before you is the end of year balance in the rainy day fund dating all the way back to 1998. And this is shown as a percent of general fund revenues because that's typically how we talk about the balance in the rainy day fund. You can see that fiscal 2023 leaves an unprecedented balance in the fund of about $3.6 billion after the statutorily required $2.4 billion appropriation. This equates to a little more than 16% of general fund revenues. The other interesting things to observe from this chart is that this is the first time in a long time that the fund balance has breached the 10% threshold. That only in the last 2+ decades only happened one other time in 2007. And in fact, prior to 2023, there's only been 3 years in this chart where the 7.5% threshold that is required in statute, where we no longer are required to put a general fund appropriation into the rainy day fund in order to increase the fund balance. That only happened 3 other times. So we are definitely, as has been said, sitting in a unique position as we consider the budget that will be coming up in the next session. The final thing that I would want to draw to your attention with this chart is the fact that, as you can see, very rarely does the state go below the 5% threshold, even when we are faced with very lean budget years. It's a rarity that funds dip below that 5%. And when they do, historically, it's really been in the 4.7% range. And so we have a few recommendations for you to consider when you think about how to use the sizable funds that you will have at your discretion in the next budget. And then also we have a few recommendations to consider with regard to how to protect the state from the next time we are faced with a downturn, because we know that as business cycles go, a down cycle is going to be inevitable at some point in the future, hopefully in the distant future. So on the next slide, we just note that best practices suggest that states are in fact better positioned when there's an established policy for how and when to utilize their reserve funds. And it's worth noting that Maryland is only one of 6 states that does not currently have legal conditions for when funds in their reserve funds are to be withdrawn. So as David just said, we are making a recommendation that you consider utilizing a little over $1 billion of the available cash to increase the fund balance up in the rainy day fund up to 10%. And then maintain that 10% fund balance throughout the duration of the forecast. That's what we've reflected in the numbers that you've already seen up to this point. The reasoning for that is, as you previously saw in the chart just before this, the state likes to have a 5% cushion, right? It makes us all feel a little safer having those funds in reserve. And so by maintaining a 10% balance in the rainy day fund, This would provide that much more flexibility, comfort, and assurance that there is an additional 5% in the fund to be able to actually utilize and access in the event that those funds are needed. Along with that, historically, when we do encounter a recession, we've seen that revenues fall by about 10% over the first 2 years of that recession. So this would allow you the opportunity to access funds over a multi-year period in order to head off any really significant decisions that would need to be made in order to account for a downturn in revenues. This would also protect the state in the event that the recession were to be deeper or longer than what we've typically seen in the past. So we are recommending a 10% fund balance. And then also we're recommending a bit beyond that and suggesting that the spending affordability may wish to consider making recommendations for putting policies in place for the next time funds do need to be accessed. And, you know, when you look at what other states do in terms of putting parameters in place for utilizing their reserve funds, there is a considerable amount of variance in terms of how stringent or loose those parameters are. But what we would suggest is that you put in place a structure that at least ties the withdrawal of funds from the rainy day fund to the downward revision of the general fund forecast. And that also in considering when to withdraw funds, that they be withdrawn in increments rather than utilized and withdrawn all at once, so as to be able to create a buffer if the recession or the need for the use of funds were to extend beyond just 1 year. The other thing that I would just highlight is the fact that what I'm talking about is the use of withdrawing fund balance. It is not uncommon for the administration or the legislature to redirect the appropriated funds in the budget to other purposes or to utilize it to fill spending gaps elsewhere in the budget. So this is policies that would pertain to taking out existing fund balance.
Delegate Resnick.
Thank you, Mr. Chairman. I'm not sure if this is really a question or just my thoughts on this, but I'm a little concerned about this plan, and maybe I just want to air it. We are AAA funded, bonded. Given our current fiscal outlook, I'm confident we're probably going to maintain that AAA bonding. We have a considerable amount of money put into the rainy day fund. We have, even in the COVID recession, based on your own chart, we never completely withdrew the existing 5%. We have so many needs in this state. It was just highlighted by Senator Rosapep that we have an extreme staffing shortage at the state level. We have massive issues with mental health care coming out of the pandemic. We have a lot of things we need to fund, and I'm just a little concerned that putting an extra $1 billion on ice is going to provide any kind of real benefit to the state other than having some cushion. Could you tell me concretely what we anticipate as a benefit other than in case of another recession, we have some extra cash?
I would note that in the chart that I showed you previously, fiscal 2021 is in fact the year that the fund balance does dip the lowest, and it does dip below 5%. And that's because over $500 million in funds was withdrawn from the fund balance to support COVID-related activities with the governor's $250 million initiative, and then the legislature's $306 million for the Relief Act. So it was able to help in the cycle where we thought that things were going to be much worse off than they in fact turned out to be. And I would say that putting the funds in the rainy day fund does not make them inaccessible. It just hedges your bets against downturns in the future. And so allows you more flexibility to access the funds. In looking at this chart, there is a general feeling to not want to access that 5%. So to have an additional 5% buffer gives you a lot more flexibility in order to be able to utilize funds when you really do need them.
All right, thank you.
I recognize one of our public members, former Delegate Bohannon.
Thank you. Thank you very much, Mr. Chair. I don't get a vote on the committee, but I can express an opinion. Unlike anybody else who is either presenting or is a sitting member of the legislature, I'll make an observation. And DLS did not include something that I think deserves or merits some real attention, maybe even a reset. Oftentimes we put things in place and it's a while before before the legislature has the opportunity to revisit and take a look at it. I think now, given the fiscal situation, which none of us have ever seen, would be a very good time to take a look at two entities. You talked about the challenges that state agencies face in both recruiting and retaining employees. You've got your own entity, DLS, and I suspect if you were to do a comparison of where DLS is today vis-a-vis competition for their talents among state agencies, federal agencies, local government agencies, and the private sector, it's you're not as competitive as you need to be. The other area that you might want to take a good hard look at as you go into the next 4-year term would be your own staff. You've got the staff members for the Maryland General Assembly. I would suggest if you're going to take a look at, you talked about the vacancy rates and whatnot, you might want to take a look at those two areas, because I think in terms of investment, it is as important an investment that you can make for the future of our state and the decisions that we make going into the future as you could look at. Again, it's a good opportunity to do. It's a good time to do it. So that's my thought, my opinion. I'm not going to have a vote on it, but I'll leave it in your good hands. So.
Thank you. Good points. But before we continue on with the other questions, I just want to remind my colleagues, we have 4 substantive sections left of DLS's presentation to go through this afternoon. Delegate Novotny.
Thank you, Mr. Chair. I'll go quickly. Question, while you're looking at this proposal, had you taken a look at states like Alaska that provide checks back to their citizens due to the pipeline, or Oregon, who provides checks back if they budget, if they come in over their budget like we are in this situation?
I have done a lot of research, and there are a lot of different methods and means for handling the use of rainy day funds or the use of excess funds. So that would be a point of additional discussion for the committee to consider whether they like the DLS proposals or whether there's a need for additional options to be considered. But there's a vast amount of information and vast amount of variety in the way states do things.
Thank you, Mr. Chair.
Senator Roosevelt, I think we're on the Senate side now.
Yeah, Senator Beidle. You're on mute and not on video. Are you there, Senator Beidle?
Can you hear me now?
You bet.
Okay. It's because I'm on the highway and I apologize. Did we look at the SHA budget at all? I understand they had cuts previously and our highways are really in a mess, both the roads themselves and the mowing and the trash. So have we looked at SHA budget at all?
We did do a review of the entire MDOT budget, and actually that is one of the substantive sections to be addressed following this or later on in the presentation is changes in the MDOT budget, but that was part of our overall review and analysis.
Thank you.
I think we're ready to keep going, Mr. Chairman.
Great. I think it's now on to Patrick Frank to talk about state debt policy.
Yes, hello. The top of the first page here on the state debt policy just reviews what the Capital Debt Affordability Committee's affordability criteria are. The first is that state debt service cannot exceed 8% of the state revenues, and the second is that state debt outstanding cannot exceed 4% of personal income. These rules basically are used to guide state debt policy so that the state remains affordable, and it provides basically a cap on what we can do, and it limits our spending. If you go to the chart on that page, you'll see 3 bars. I'll first talk about the yellow bar, which basically that is the policy that the state has been following since at least 2015, I believe it's 2015, in which what happened was at that time, the state was very close to breaching the limits, and there were concerns, especially if there were an economic downturn, that it would not take much of a downturn for the state to breach the limits. So at the time, the policy was made, and it was adhered to year after year to limit the growth in authorizations each year so that they're not more than 1% over the previous year's authorizations. And the reason for this was that at the time, the state property tax, which is the main source of paying for the state debt service, was expected to grow about 1 or 2%. And the state, I should say, wanted to keep those costs growing at a lower rate than the state property tax. Now, and that's what the policy has been now for over half a decade, and almost since I guess it's 7 years now. And so this is this bar shows that. The second bar I want to talk about is the blue bar to the left, and that is the Capital Debt Affordability Committee's recommendation. And what they recommended this year was to reduce it to $900 million, the authorization this year. I believe this relates to the surplus, and that we would use more PAYGO funding instead of as much debt to support the capital program this year. And they also continue on this path of 1% growth each year. Now, as already been discussed, also is a third option that we're modeling here as well, and that is the idea that inflation is higher, and then so maybe authorizations could grow more in line with what's happening on the capital spending side as opposed to the revenue side. And so what you have here is instead of going the $1,115,000,000, which would be the authorization this year, is to add $50 million to it, as the same number that was shown a few pages earlier, as part of the just to acknowledge the inflation that's already in the economy, so that the program in 2023 keeps its spending power. And so the idea then moving forward is to grow it at 4% a year, and because we anticipate that inflation will be higher in subsequent years. And so those are basically 3 kinds of policy options. Do you want to reduce it this year and then grow slow, like revenues are growing, or do you want to maybe go to a higher level? Next slide. What this page does is it shows how these different rates are affordable. And basically, as you can see, if the first table, the debt outstanding, it's supposed to be below 4%. In all cases, what you have is a situation in which the ratios are declining. So we're in very good health. We're nowhere near our limits. And under all these plans, you will see a decline. Obviously, the less you authorize an issue, the declines a little more quickly. Same situation with debt service to the affordability ratio. They're declining in all years in all of these different options. I think maybe most interesting in this is the chart at the bottom. And what that shows is it starts with what our policy, or what the current modest growth policy, what the debt service costs are for the forecast period. And then it compares the CDAC's approach of reducing it by $250 million in the current year, and also the adding the inflationary increase that the higher inflation. And so you can see that it's some modest savings. Because of the way this is funded, all of these would eventually be general fund savings because the primary source is the state property tax. And since this property tax is set at a rate that's lower than the total debt service cost, there's an additional appropriation general fund made. So you're looking at maybe say $80 million more if you go in 5 years, if you go with the higher inflation approach, and maybe a savings of about $17 million if you go with the lower cost, or where you reduce this year's authorization. Next slide. And this final one addresses another issue that was on the page, showing some of the options that you can do to use the general fund surplus. And this has to do with the bond premium. Basically, I can just hit the highlights with this. In fiscal 2023, the estimate is that we'll get $202 million in premium. We've got $125 million of that to support the WMATA Transit Authority for some capital grants there. That leaves $77 million of those premiums that you're using for debt service. If you were to, or the administration were to appropriate another $77 million for that debt service, then what would happen is you would save $93 million. And so that is an example in that where if you take the cost now, you actually will be saving money in the longer term. And so we recommend that you take a look at that and that we provide the general funds for that. And that concludes my share of the presentation. And take up questions if you have any.
I do not see any questions. If you want to go on to the capital program and Matt Klein.
Okay, thank you, Mr. Chairman and members of the committee. This section is going to dovetail a bit on some of the concepts that Patrick's laid out. The first being the recommendation of the Capital Debt Affordability Committee, which is to reduce the authorization level for fiscal 23 only, and then return to the amounts that were programmed in the current CIP that was presented in the 2021 session by the governor. The slide on page 25 is an attempt to try to orient what that means, the CDAC's recommendation. And it could require upwards of $545 million of PAYGO before any expansion of the capital program could take place, even with the state's strong cash position and projected structural general fund surplus. So the slide on 25 starts with replacing the $215 million that the CDAC recommendation would take out of the current CIP. It also adds in 150 to the Department of Legislative Services General Fund forecast, including some repayment that's required in fiscal 23 for the program open space replacement, and $42 million that was programmed in general funds in the CIP for the WMATA grants. It also includes something that David Romans had talked about earlier, which is the General Assembly has made commitments above what is currently in the CIP with a number of pre-authorized projects, roughly $125 million. And these projects would also represent potentially upwards of $300 million over 24 and 25, because all of these projects have multi-year commitments that would be required to fully fund them. It also includes something I'll expand on a little bit more and has been discussed, which is the cost of the impact of what's happening in the construction market with respect to inflation. Roughly $50 billion estimate of what it would take potentially to fund projects that are going to go bid in the next 18 months, the remainder of fiscal 2021, as well as through 2022, as well as projected for fiscal 2023. So before any expansion could take place, you could be looking at upwards of $545 million just to get to, a base level of spending relative to the CIP and the commitments that the legislature's made, as well as dealing with the impacts of inflation. You can turn to the next slide. This is an attempt to try to orient you with the concept that, even at the current authorization level, the state's authorization level does not really keep pace with the demand that the agencies have for capital funding, the requests that the Department of Budget Management field annually in the interim. And so both the authorization level and the projected, the current and the projected general fund surplus is an opportunity to try to bridge some of this gap, which is upwards of $660 million in fiscal 2023 alone. And that fluctuates over the years based on agency requests. So that's one thing. And then the next is, the budget surplus is also an opportunity to address some of the longer term issues that the state has at this point not been able to fully address, and that's the facility renewal problem. The state has upwards of $200 million of deferred facility renewal, about another $35 million in deferred facility maintenance, which is the operating piece. And that does not include the University System of Maryland, excluding projects in their 5-year plan. There's roughly $800 million of deferred maintenance that remains unaddressed through the University System of Maryland campuses. It would also be important when considering what to do with facility renewal to recognize that it would also take a significant operating investment to invest in the tools that would produce data-driven decisions and assessments that could be used to sort of drive how the additional resources, if they were to be brought to bear for facility renewal, could be used. And there's also the work of the State Park Investment Commission, which has been actively meeting during the fall, and they've got a number of recommendations likely to result in recommendations to expand the level of funding that currently flows, most of which flows through the program open space formula through the transfer tax. And again, the parks also have their own level of deferred maintenance, roughly at $80 million. Although, again, if the assessments aren't really up to snuff, it could in fact be significantly higher in all of these cases. But the point is that, there are a number of things that the committee is in the General Assembly is going to consider with respect to what to do with the general fund surplus and bridging the gap in agency requests, as well as addressing some longer term structural issues like deferred maintenance and facility renewal could and should be on the list. Turning to page 27, this is a bit of discussion of what's going on with construction inflation in the construction market, and it ties into some of the scenarios that Patrick had just laid out in the state debt section with respect to different scenarios on what the committee could consider for what the debt level should be for 2023, as well as through the planning period. And the slide on page 27 shows the year-over-year construction inflation in the Baltimore regional market from 2017 through September of 2021. And after a rather sizable decline in year-over-year construction costs in 2019, with the onset of the COVID-19 pandemic, this cost factor has gone up considerably, almost 10%. In calendar 2021 alone. Most of that took place from about June through December, and then through September of 2021, another 20% increase on top of that. So there's significant pressure on the capital program to try to keep pace with inflation. And this is where the roughly $50 million of investment we think is likely to be needed for state-owned projects that are either in the currently going to be bid in the next 18 months or programmed to be. It also has an impact on grant and loan programs. Even if those funding levels don't go up, it just erodes the spending power of those programs if the funding level stays the same. And that's the segue to the slide on page 28. And this puts in to perspective the level of funding that of GO bond authorizations that were provided in fiscal 2022, little over 1.1 billion, and then builds in an inflation factor of 4% on a year-over-year basis, and it goes down to 865 million in 2023. This is the lower authorization level that CDAC has recommended. And while it goes up in 2024, because the authorization level in the committee's recommendation increases, the year-over-year impact of inflation still puts that below what was authorized in 2022. And each year thereafter, again, the impact of inflation by the time you get to 2027, roughly 935 million would be the spending power relative to what was actually, what is actually recommended by the committee. And there's also one other plug there's in there, which deals with the construction contingency fund. The committee and the budget committee should consider increasing the level of funding in the construction contingency fund as an additional hedge against rising construction costs over the last 18 months. There's a statutory cap on this at 1.25% of the authorization level. That would be roughly $14 million. The available balance is significantly below that. And this could be another place that the state could use some of its funds, general fund surplus to try to increase the level of funding in the construction contingency fund, again, as a hedge against rising construction costs. And that is what I have on capital. I'm happy to take any questions, Mr. Chairman.
Thank you. I do not see any questions. I think we can turn to Steve McCulloch for the transportation overview, which he can inject right into my veins.
Thank you, Mr. Chairman. Page 29 starts the Transportation Trust Fund forecast look. The table at the top of the page compares the forecast that MDOT provided in January, that's the first column of numbers, versus the 2022-2027 forecast that was released September, with the difference column showing the change between those two forecasts. As you can see, revenues increased by about $1.5 billion between the two forecasts, signaling both a return to better times, but also if you look at the federal stimulus line, there's $740 million additional funding in the September forecast than had been assumed in the prior one. So that really helps drive that increase in the forecast. The last two columns are the DLS estimate and the difference from DLS and the September MDOT forecast. Largely the same. The largest change is just the fact that the DLS forecast was done after the fiscal 2021 close, and that closed out over $200 million higher than MDOT had assumed in its September forecast. Looking on those increases in revenue basically translate to a larger capital program, as you can see on the expenditure side of things at the toward the bottom of that table, $1.4 billion increase in the MDOT September forecast relative to the January, and the DLS forecast, recognizing the additional funds at closeout, also slightly higher revenues and the ability to issue slightly more debt leads to another $377 million that could be spent on the capital program. Next page, please. Which this is the capital program then. This page compares the Consolidated Transportation Programs, or CTPs. The top chart just shows total state funding for the capital program and compares the January 2021 forecast with the draft that came out in September. And as you can see, the taxes and fees that support the capital program increase in the September forecast. The yellow band represents bond proceeds, and you can see that that is lower in the current forecast, and that's largely a result of the debt service coverage ratios approaching their minimums. And we are going to be seeing less debt issued over the next few years than we've seen in the past few years for transportation. And then the final green band is other state funds. This represents the general funds for WMATA, the bond premiums for WMATA, and Howard Street Tunnel funding as well. So all in all, the CTP stateside program increases almost 25% over the January forecast. The chart at the bottom of the page then just shows two forecast comparisons by mode of the business units of transportation. And you can see the blue bars are the January forecast and the yellow bars are the draft September forecast. I'll note that the MTA is the outlier with a 30% increase over the January. That is largely driven funds added in the current year to address the Purple Line settlement and debt repayment. So there's over $500 million were added to fiscal 2022 for those items. With that taken into account, the rest of the forecast, there are slight increases in MTA funding in all years of the out year forecast. That concludes my portion of the presentation, Mr. Chairman.
Questions? I think we're turning to Dave Romans for the infrastructure package update.
This is the last page of the document. So what we know about the infrastructure bill is somewhat limited, but we think at a minimum, Maryland will receive about $2.9 billion of new money. And I emphasize new money because the bill also reauthorized some existing transportation grant programs, for example. So some of the information you may see in various press releases is including the total pot of money, but a lot of that is money that we would have expected to get in a normal year. So we're focused on the new money. 2.9 billion. One thing to keep in mind is that we'll probably get more than that because quite a bit of this money is competitive, especially in the transportation area. So we erred on the side of caution in terms of projecting, but if Maryland is successful in getting some of the competitive grants, particularly in the transit area, we could get quite a bit more funding. The other thing that makes it difficult to estimate is in some cases, Congress has authorized an amount of money and told the federal agency to go figure out how to allocate it through some formula. So broadband, for example, we know Maryland will get 100 million. So every state is guaranteed 100 million, but then there'll have to be a formula developed for allocating the remainder of the money. So we could get quite a bit more or just a little bit more, just depends on the formula. So it's a little difficult to give you a really good solid number. But you can see from the chart, most of the money is going to transportation, roads, bridges, are getting more than $1 billion over 5 years. Transit gets a big chunk. The other really big investment area is clean water and lead pipe replacement, where we're going to receive more than $800 million. So a lot of opportunities there to address the quality of our pipes and so forth. And then there's a whole host of other smaller grants kind of summarized at the bottom: weatherization, electric vehicle charging infrastructure, energy programs, and so forth. So we'll update this as more information becomes available, but this gives you kind of a quick look at what we might see. And that completes our presentation, Mr. Chairman. Happy to answer any final questions.
See, Chair McIntosh was up first.
Yeah, well, you answered my question. I missed it on the chart, and that was the Chesapeake Bay is still in the bill. Am I correct?
Correct. I believe it's $238 million is earmarked for the bay.
Very good. Thank you.
I think we're over to the Senate.
Senator Elfreth.
Thank you, Mr. Chair. Thank you, David. Just briefly, the lead pipe replacement, does that target schools or target any particular infrastructure, or do we kind of have a carte blanche?
It's pretty much to replace any lead pipes in our water infrastructure.
Okay, thank you.
Delegate Solomon.
Thank you, Mr. Chair. David, I appreciate the summary here. Just any details you all get on the road safety pieces. I think a lot of us are dealing with pedestrian safety infrastructures. We recently had a death in my district not too long ago on a road that we've been working on for a long time. So any details on how that funding can be used and potential ways to allocate it would be much appreciated. Thank you.
Yeah, I think just before I turn it back to Senator Roosevelt to finish us up, I think the question many of us are going to have is how this money over the next few years can get allocated and prioritized, and not just us taking a back seat or, in my case, a back train car. But let me turn it back over to Senator Roosevelt.
Well, Senator Salling wants to ask a question.
Thank you, chairs. Just wanted to know, I see the amounts that we do have here for the infrastructure investment for the state of Maryland. I was just wondering, I see the amounts in detail, but it's not really specific. Is there something or a way that we're going to be looking into that specifics of, like, for instance, of roads and bridges? That's kind of what transit is not. Or you would say broadband in our schools or in areas. So are we going to get maybe some of the things more specific and be able to talk about that? Thank you.
Over time, we certainly will. As I said, like, for example, the bridges funding is going to be allocated largely based on how many bridges each state has that need, that are considered not particularly safe. So it's really hard to say right now exactly how much we'll get from some of these specific items because the federal agency has to figure out how to distribute the money. So over time, we certainly will be able to provide you more, but there's kind of a lack of detail on a lot of this because of those kind of issues. And just a lot of it is competitive. So the state has to go out and win the grants for specific things we want to do.
Thank you. Thank you.
Thank you, Dave. I got two questions, and then hopefully we're going to wrap it up unless somebody else has some other questions. One is on the infrastructure money. Yes, it's unclear in the sense that there are going to be formulas, there are going to have to be decisions made. On the other hand, it's clear in the sense the bill has passed both houses and the president has signed it or he's about to sign it. So this is real money. What is your impression right now, and when do you think you'll have a more detailed impression of how much of this money is likely to be available in FY22 versus FY23 versus post FY23?
Yeah, I mean, it'll take a little bit of time. Some of this money, I mean, it's over 5 years. So some of it is going to be divvied out, a portion each year over the 5-year period. So for some of the pots, it's not like we just don't get it all at once and we can just.
I understand that, but I think year one is FY22, isn't it?
I mean, some of the money would start becoming available this year, yes.
Okay, well, if that's something you could do a little deep dive into with the agencies or with our federal office or with a congressional office, I think that's important going into the session to understand how much of this federal money is likely to be relevant for the FY23 budget or amendments to the FY22 budget. So if you could look into that, that would be helpful.
Sure.
Second question, I think it's Appendix A or Appendix 2 attached to this. There's a summary of almost $4 billion of the American Rescue Act money, I believe. Which, can you put that up on the screen? It's Appendix 2. It adds up to something less than $4 billion, and it says substantial amounts not yet in budget. How did these numbers relate to all the other numbers you showed us?
So most of the numbers we've talked about today are general funds. We've focused on state funds. These are federal, mainly rescue plans. Some of them go back to the December stimulus as well. Dollars that are available to the state that haven't technically been added to the budget in some cases because it hasn't been decided exactly how they'll be used. In some cases, there is actually a plan. Like, for example, the first line there is the State Fiscal Recovery Fund, which is kind of a flexible pot of money. The plan is for more than 500 million of that to go to the Department of Transportation, and they actually have it in their draft CIP that they're walking around this fall, but it hasn't been technically added to the budget. So a lot of it, there's a plan to do it, but we haven't seen it actually proposed as an appropriation.
So from a macro point of view, you would expect these numbers to be added more or less to amendments to the FY22 budget or added by the governor to the FY23 budget?
A lot of it will come in 22 and 23. Some of it may, like some of that transportation money may get spent over a longer time horizon.
Okay, thank you. That's very helpful. Are there any other questions from members of the committee? Going once, going twice. Chairman Corman, you have a final comment?
Just a reminder to the SAC members that we meet again December 15th.
Take the evening off. Thanks, everybody.
Thank you.